the fiscal spending and just going to continue. It has to continue. It's what's levitating this economy, running these basically 6, 7, 8% of GDP deficits and just piling on debt. This will work until it doesn't work, but there's going to be ramifications for that, and I think there's various vehicles to put money into that will benefit from for those very bad policies that seem good in the short term but end up being very negative in the long term.
Hello everyone and welcome to another edition of Triangle Investor Interviews. I'm your host Lucian Valkovic, and before I announce my guest, just a reminder of a disclaimer: this interview and all my interviews are not a recommendation to buy any shares, products or services. Always consult with your financial advisor and do your due diligence. My guest today is John Polomny, probably one of the guests that I really respect the most when it comes to the commodities and energy. Very known name. John, really delighted to have you back. Welcome, sir.
Thanks for having me, Lucian. Appreciate the invite.
Thank you. I look forward for this discussion. We have a lot of things to unpack because you were in my show, if I remember correctly, like 4 or 5 months ago. So a long period, and I'm looking forward to discuss a few things. Let's start with a big question. My first question is always a big question. Given the mixed signals in the economy, persistent inflation fears, potential rate cuts, recent volatility, equity markets, what's your current assessment of the broader economy and stock market trajectory for the next, let's say, 6 to 12 months? And where do you see the biggest risks and opportunities?
So, the economy, it's kind of chaotic right now, right? Because I think that the Trump administration originally had a plan to do certain things. I called it the 3-arrow policy, kind of modeled on what Abe did in Japan to some extent. Basically, they were going to cut spending, that was going to bring rates down, and energy prices were going to drill and all this. And I think that's kind of been thrown over the side. Mr. Trump and his administration, the people that are in there, are they have a view on tariffs that trades as kind of a zero-sum game, I think. I don't necessarily agree with everything that they say on that, but I think there's a lot of chaos right now and uncertainty, and of course the market doesn't like that. And the other issue, I think, is just what I would look at around interest rates relative to the rest of the OECD countries and a lot of countries around. I track interest rate central bank actions because I'm kind of a believer in what Stan Druckenmiller said, that markets are kind of in the short and medium term driven by liquidity and sentiment. But most of the central banks around the world have been cutting rates for a year and a half, going on 2 years, and our central bank is still not doing that, mostly because I think that I don't think that they're really good at their jobs or anything like that, but they got it so bad during the last administration when inflation got out of control. They're always late to the game, and so you have this situation where we have kind of higher rates relative to other people around the world, especially the OECD countries. That's affecting things in the economy. Specifically, the housing market's kind of frozen. I just saw a survey today that the majority of people, if they sold their house, they wouldn't sell unless they can get an interest rate that's less than 4%. Well, current mortgage rates are like 8%, right? So that's kind of frozen. That's a big part of the economy. And so I don't like to get too much into economic forecasting, but I just see a lot of chaos. That creates uncertainty. But going to your second question on the markets, it doesn't seem to be affecting the market. We're making new highs. We're kind of in a bubble, I would say, has a lot of similarities to what I saw in the early aughts with the internet bubble. And I'm not a big fan of buying things that are overvalued. The research is very clear. The more that you pay for a security or investment, the less your returns are going to be over the subsequent 5 to 10 year period. What you basically have is some confusion going on. it feeds on itself. It's a speculative bubble, and things are going up, and things were up yesterday, things are up today, so they'll probably be up tomorrow, and that's what, people have this Pavlov response to just buy the dips, and because that's worked. And so I think that'll work until it doesn't work. And, however, I kind of focus more on looking at things that are undervalued. I like to not buy things or sell things that are overvalued and buy undervalued securities. But anyways, that's kind of my view. I mean, you're looking at. I saw a chart the other day. I put it up on my Facebook group for my newsletter guys, but it was a Palantir chart showing the stock price, basically going. It's a rocket ship. It's something you saw during the last internet bubble or the last speculative bubble in the early aughts, where you had things like JDS Uniphase and some of these other companies that would just go straight up. These things always reverse and come back down at some point. So, I mean, if you want to buy Palantir, for example, at 700 PE and 100 times sales, I would suggest to you that you're not really investing, you're speculating, you're hoping that you can sell it to somebody else at a higher price, but it's not based on any fundamentals for the company. There was a good article that a CEO of a company during the bubble, his name was Scott McNeely, I think. He was the CEO of Sun Microsystems, and he wrote an article which is still available on the internet, telling when that stock was in the middle of a big speculative bubble, and he wrote to the shareholders and told them that this is a bubble and this is why it's a bubble, and explaining what would have to be required for them to get a actual cash return from the company, and it was just impossible. So we're kind of in the same situation. It may be worse because now we have such a reliance on passive investing. I don't want to go down that. That's a Michael Green thing. People can go check him out. He's an expert on that. But it's kind of a self-reinforcing thing until it's not. And so when people say, well, I've posted things or say things about this, and some wag will come along and say, well, this sounds like sour grapes, somebody that missed out. I just cannot make myself. I've seen this before, and I cannot buy things that are extremely overvalued. It just doesn't make sense. So I kind of think that's in summation where I'm at with the economy and markets. Obviously, there's still opportunities everywhere. There's always an opportunity. So obviously, I think we'll probably get into that. But I think that the fiscal situation, I really thought it was impressive. I'll just finish with this. The talks recently and how it was laid out by Lynn Alden about. I really like that metaphor. Nothing stops this train, talking about the fiscal spending, and just it's going to continue. It has to continue. It's what's levitating this economy, running these basically 6, 7, 8% of GDP deficits and just piling on debt. This will work until it doesn't work, but there's going to be ramifications for that, and I think there's various vehicles to put money into that will benefit from for those very bad policies that seem good in the short term but end up being very negative in the long term. So I'll stop there.
A very good point, but all that is correlated with the energy, of course, the economy and the whole big picture. How do you assess the impact, let's say, of central bank policies, like potential rate cuts or persistent inflation on energy and commodity investments in the next 12 to 18 months?
Well, I mean, there's definitely a historical correlation between the dollar and resources. There's also a correlation between rising PMIs and commodity prices. And so if you have all these central banks around the world cutting rates and weakening their currencies and trying to get bank lending going, at some point, this has the tendency to push economic growth higher. You get rising PMIs, rising demand for commodities. But I think with respect to the dollar, because the dollar has been weak, regardless of the fact that the interest rate differentials are what they are, the U.S. hasn't cut rates. Now, if you look at the CME forecasting, if you want to look at maybe 3 rate cuts for the rest of, coming up pretty soon, as the central bank in the U.S. starts cutting rates, this could be, very negative for the dollar, and that would be very positive for commodities. That, in many respects, in my view, a lot of them have already broken higher and broken out. Which we can talk about. I'm cautious to use the word supercycle, but just because of we're having basically a confluence of events that I think that are going to lead to higher commodity prices over the next decade. But I think one of the major things is the U.S. dollar and the weakening of the U.S. dollar over time, just based on the physical situation and the need for basically printing money to. I mean, there's no way out of this at this point. I mean, Ray Dalio talks
Yeah.
about this. And this is historical what we're living in right now. So there's no impetus to do the right thing because it's not politically palatable, and basically the people don't want spending cuts. So it will continue. This will, I think, is an underlying positive bias upwards for many commodities, especially gold, which I believe is going to be is being remonetized. But yeah, I think overall, you know, you have this underlying like slow boil going on that's providing impetus for higher commodity prices. But then also, I think you bring together the underinvestment and the demand that's happening for, you've seen Europe, the U.S., China, just going crazy with announcements for fiscal spending in the billions and trillions of dollars. This is going to have an effect, notwithstanding the fact that the emerging middle class in the global south and east, which is in their S curve moving up, will demand more commodities too. And you can look at any commodity you want, like copper, if you want to look at the new mine finds, substantial mine finds, new large pools of oil being found. People are just not out doing this and looking for these things because it hasn't been economically feasible to spend money to do that. But I think that's all coming together now for a higher prices over time.
Yeah, yeah, agreed. John, let's talk commodities. What commodities are on your list? Let's say your top five undervalued, cheap commodities as we speak. What are they?
So, I've been saying this for a while that energy, specifically oil, is very cheap. It's been underperforming. Everybody hates it. Everybody thinks that we're going to have oversupply. But when you look at, I look at the relentless, two things that are relentless. Basically, adding about 1 million to 1.5 million barrels a day of demand every year. We're up to about 104, 105 million barrels per day of demand. That's a lot of demand. That's 36 37 billion barrels a day, a year of oil demand. And then you stack on top of that something that most people don't even think about or talk about, which is the depletion that goes on. I'm not going to talk about individual fields, but overall, Exxon did a study several years ago where they estimated that worldwide depletion 6 to 7% a year. So on 106 million barrel 105 million barrel demand, that's about what, 6 million plus another 1.5 million. You basically have to find and bring online a new Saudi Arabia every year, and we simply haven't been doing that. I heard Rick Rule say recently that the industry is starved of capital to the tune of $2 billion a day. And so these are depleting assets. They're extractive industries, and if you don't reinvest, it's inevitable that you get to a higher prices at some point. You run into a problem. And what's interesting, what people forget about commodity investing or resource, it seems like I can sit here and say that, and people say, "Well, what's this guy talking about? It's $70 a barrel Brent, and inflation adjusted, that's like 50 from 10 or 15 years ago." That's exactly right. Nothing ever happens, and then all of a sudden these things just seem to take off. Perfect example, which is another one I like, platinum group metals. We've seen what's happened in platinum, palladium, rhodium. Same situation there, underinvestment. I like those metals. There's only a few vehicles to take advantage of that, but I would say other than that, some of the things I'm looking at is like if you look at potash has recently broken out recently. No, it hasn't really got a lot of play yet, but it's really moved up substantially. There's just a few players in that market that you can play it, uh, and so I think that that's a good opportunity. And then I would say, probably copper and uranium. You can flip them 4 or 5. Copper. I don't even base my view on copper on AI or EVs or anything. It's just the normal demand that's required, as I said before, as these billions of people enter the S class, and as you get to a certain GDP level, in each country requires a certain amount of pounds per copper. And these are historically based on other countries that have industrialized or gotten wealthier. And so the problem is that we have billions of people that want the lifestyle that we have. They want the conveniences. I mean, very few people still have air conditioning in India, as an example. So, and then if you want to put on the amount of demand that's going to come, if you want to start layering on data center and AI build outs and things like that. I saw an article recently where somebody talked about the new processing rack from NVIDIA requires, I mean, this is just one rack. It requires like 20 something pounds of copper or something. It's just crazy. So, and again, it's not like these things don't exist in the earth, but they getting harder and harder to pull out of the ground, requiring higher investment, more investment. It's just not happening. And so, uranium, I mean, uranium's the biggest, not, it's the biggest layup of all time. The problem is with uranium is how do you put on a position that makes sense? Because the vehicles for playing it, you basically have Cameco, which is kind of overvalued now currently, and then you have all these crappy juniors that you have to wade through. So it's I think it's probably the best fundamentals and obvious fundamentals, but just how do you make a position that you can take advantage of it? So I think those are probably my top five right now.
Okay, let's stop on uranium. John, what catalysts do you see driving the next leg of uranium bull market?
Oh wow! I mean, I just think I don't find it humorous. I kind of warned about this. Other people did too that have followed this. I go in with the assumption that mining really sucks as a business, whether it's uranium mining, copper mining, whatever mining. And there are short periods of time where, because of the price of the underlying commodity, you get excess returns. And I think what we've seen is a situation where you basically had a decade where basically nobody did any investment. Everybody knows this. And so now we have all of this demand coming online, announcement after announcement every just about weekly, if you'd like, about more reactors
Daily,
being,
daily.
yeah, exactly. Just here in the United States, they're going to, you've got Dwayne Arnold being brought up back online. The second reactor at 3 Mile Island, Constellation's going to bring that on with Microsoft, and Palisades up in Michigan. And so this is, you take those three reactors, and that's about 1.5 million pounds a year of demand right there, a million to a million and a half pounds. Not who is accounted for that? Who's going to provide that? Notwithstanding the fact that, as you just alluded to, I mean, every day you're getting an announcement of more reactors being built or being planned. And so nuclear is the future, especially, just at current demand and forecasted demand. There's not enough uranium. It's just that simple. And so it's now becoming I mean, it's ridiculous that the United States is in this situation. The United States should be leading the charge on nuclear. It finally has an administration that gets it, but it's not something that you can just fix in a month or just code it up in India with some coders. So you have a situation where we use 40 million pounds of uranium for our 90 some odd reactors here that supply 20% of the US's base load electricity, and we produced last year 400,000 pounds of uranium, and we do very little enrichment here and some of the other things that are required. This is a complete joke. Can it be fixed? Yeah, it would take 10 to 20 years and tens of billions of dollars. Will they figure it out and fix it? I hope so, because the Chinese and Indians and Russians are going to run away with this market, a market that we should be dominating. So the demand is there. It's a growth industry now. The supply, I don't know. I've said this. At some point, you're going to have a musical chairs moment where and these utilities, I think, are still, a lot of them, just if you talk to people that go to the WNA every year, the utilities are still kind of just assuming that the product will be out there. They're not doing the long-term commitments. Hey, it'll be there. I don't have to worry. And I don't see it. I know how hard mining is. I hear about all these, well, don't worry about the next gen project. Will take care of it. When are they going to start building it? Who's going to build it? Where's the money going to come
Exactly.
from? How hard will it be? And then you look at all these, let's just go down the list. I mean, these little rinky-dink brownfield, I mean, Encore. I mean, if you look at Bill Sheriff and those guys, they kind of have, like, the guy on the board there, he's like 80 years old. I forget the guy's name. He's been out in the field here in South Texas supervising the ISR stuff, because he was they were having problems. I mean, they were having problems. They couldn't get enough drill rigs, couldn't get enough guys. You look at Peninsula, they had to puke up. They can't meet their deal with their utilities. Boss Energy now comes out last week or two and says what? Well, the resource is a little bit more. It's not as contiguous. Prices are going to go. Our all-in sustaining cost is basically going to double, and so that gets hammered. Then you look even like Paladin at Langer Heinrich. Yes, production was up, but and the recoveries were good, but people were a little bit still disappointed just on it's kind of like a roller coaster, So where is this uranium? And then these are just rinky-dink operations. If you're trying to bring on huge mines that are going to supply, 5, 10, 20 million pounds or whatever, I don't see anybody building these things. I don't even see anybody talking about building these things. So I'm curious where all this resource is going to come from, because these are, again, long-term endeavors that are going to take 10, 15 years. So
Yeah.
that's kind of my view on it. How you manifest that into a winning strategy to take advantage of it is the difficult part.
Yeah, agreed. And I have been trying to address all those problems you mentioned over here on social media about production not coming and production hurdles that a lot of companies have. Quick return to oil. You've discussed the impact of Iran dumping 100 million barrels of oil on the market. How do you see this affecting oil prices in the remainder of 2025?
Well, I think we're kind of like a little bit past that right now. I think everybody's focusing now mostly on the return of barrels from OPEC, which I think a lot of that's phantom barrels.
Yeah, or that. Yeah.
Yeah, it's a lot of. I think that the market is. There's several things going on. I mean, they're bringing these barrels back, whether they're the actual barrels. I don't think so. I mean, I just saw the Saudis or Saudi Aramco just raised their pricing to their customers, so that's not indicative of a weak market, in my view. I think that the major thing I think people should focus on, which I think is finally coming to fruition, and people are admitting it now. It's not just random bloggers or people like myself out here, or Josh or Christine Guerrero saying this. The Permian now is acknowledged as, at least at these current prices, as peaked. Whether it's Chevron, there was an interesting. People can go look up Diamondback Energy's earnings call I think it was a couple days ago, and the CEO basically came out and said that we're not going. We just can't at these prices. Basically, we're going to lay a lot of this stuff up. They can't. So the drill baby drill scenario is not there, and this is the area which basically for the last 10 years basically was where all your marginal new supply came from. And if we have peaked, I'm still not convinced it's a geological phenomenon. I think it's a combination of geology and pricing. I mean, if oil was to go to $100 or $120 a barrel and stay there, there's places to drill out there. But at current pricing, it doesn't make sense. The returns are not there. And all of the poor managements that were in place that were incentivized just to drill back in the 2010s are gone, and the focus now is on cash flow, debt reduction, and returns to shareholders, not drill baby drill. And it's kind of counterintuitive. Why would you? And I'm kind of disappointed in the energy secretary he knows better because he used to run a fracking company. He knows that you can't have production go up when prices go down substantially. It's counterintuitive, but they're still out there saying drill baby drill, and you have all of the CEOs saying they're pulling back and cutting spending because at this price you can't, it doesn't work like it used to. And this is to be expected as you exhaust the easily picked fruit. That doesn't mean there's still not a lot of oil out there. There is, but you also have all these water issues, and people are ignoring some of these water disposal issues and things like that. But this is getting into the weeds a lot. So I think that you just have that relentless upward pressure. There's only been 4 times in the last 50 years where oil demand has went down, and these were major worldwide financial. So I'm counting on that. I'm counting on just the ease of use, the ubiquity, the ease of transportation of oil, and how it has inculcated itself into our economies. It's not going away. And I just think there's been insufficient investment. I mentioned the fact that we're using now 37 billion barrels a year. We're not replacing that. And so we're living off finds that were made in the 60s and 70s, and these are eventually going to deplete. And so This is why I think you're seeing a lot of activity now. You're seeing a lot of the majors as their reserve life indexes have went down. Where are they going? They're moving offshore because this is where a lot of, and this is where more risk is and higher cost projects. But if you are a good some of these companies, and like Total or BP. BP just found a huge oil find, the biggest oil find they found in 25 years. They announced last week. So there's still a lot of oil to be found. It's just going to be riskier and take longer and cost a lot more money. In the meantime, I think that there are certain assets that are going to benefit from this. This is why I'm a big fan of the Canadian oil sands, which we can get into that. But they're just, this is a situation, for example, where all of the money's been spent to build the facilities. Now they're just sitting there, whether it's because of the government or whatever, they're just sitting there printing cash. All they have to do is spend maintenance capital, and the rest of the money, well, what do I do with all this cash flow? Even at these current prices, they're cash flowing very nicely. So they say, okay, well, I'll pay down my debt and return capital to shareholders. That's what they've been doing. So,
right.
Yeah.
John, natural gas markets often get less attention than oil or uranium. Are there any untapped opportunities in natural gas that investors are overlooking? And how do you see, let's say, LNG demand or infrastructure developments shaping the sector's future?
Well, natural gas, I have never had really a lot of success in. I do follow it just because I'm curious about this energy build out that's going to happen for all these data centers and the gas turbines and stuff. But I mean, it's so hard to, I think, game it. You're right. LNG capacity is being increased. I mean, right down the road from where I live, they're building a huge Brownsville LNG, and you see announcements left and right about new trains at already existing facilities. It's just so difficult to, I think, kind of make money by buying natural gas producers. I like pipeline companies. Some of them are very interesting. They're not going to be 10 baggers, but depending on what your financial situation are, I think looking at that. But I don't really have too much of an opinion on natural gas because even in 25 years of why I very rarely am able to game out natural gas. It is a true widowmaker in my view. So yeah, I kind of shy away from it.
Yeah, some argue that the green energy push is overhyped and unsustainable, actually. As a contrarian, do you see opportunities in traditional energy that others are dismissing too quickly, maybe?
Oh, absolutely. I mean, the green energy hype is over with. We went peak ESG probably a year ago, and the final nail in the coffin is, this Trump administration being elected. I think there's tremendous opportunities like in coal, thermal coal. If you look at pricing, it's kind of bottomed. A lot of the producers are been out of action. Their prices are down. It's another ignored, but coal usage was the highest it's ever been last year. It will probably make a new high this year. Why? Again, it's easy to use, the ubiquity, easy to store, transport. And so it's, when you look at the emerging markets and developing markets, they're not going to build nuclear power plants. And if they don't have the ability to build a big, huge regasification facility, then they're going to import coal and use coal. So I think it's not going away either. And I think the same thing is, people that have existing assets that are cash flowing, they're kind of in the cuckoo bird seat because they don't really need to do much except maintain the facility and continue to, I mean, I like, there's a few companies out there that are, even with lower prices, are cash flowing very nicely and paying very nice dividends. And I think that we will see, a higher, probably sustained coal price going forward in the future, both thermal and metallurgical. So I think it's another one of those situations where you've got a captive audience and nobody's going to, like, if I just decided to go out and just buy or I wanted to build a new coal mine, who's going to give me the money? No one's going to loan me the money for that. Number one, the banks probably still wouldn't do it. And so if I have an existing facility, I'm good to go. That's why I like a company like Glencore, because they kind of get it, and they took I wouldn't say a big risk, but they took a risk like buying, some people would say stole Elk River, the coal deal from Teck Mining, which wanted to go green. They wanted to focus on green metals, which means copper. And so everybody wanted to sell off their coal assets. So I would say that, I think that's still a good opportunity.
Okay, you mentioned opportunities a few times. For let's say I am a retail investor with let's say I have a limited capital. what's the one energy stock or ETF you would recommend as a long-term hold and why?
If I was one thing that I would recommend, well, risk adjusted, I mean, I would say, well, two, I would either, depends on your risk level, how much risk you want to take. I think people should go and look at something for the next 5 years. The Canadian energy sector, specifically the oil sands, are going to consolidate. People should familiarize themselves with a gentleman named Adam Waterous. He runs a private equity firm basically in Canada. He basically has an energy private equity firm. They own a big chunk of this company called Strathcona. And people should listen to what he said, how the industry is going to get consolidated among just a few players up there. I think that that's going to be, if you look at all of them, they're just tremendous opportunities. You buy a basket of these things, seeing, Canadian Natural Resources, Suncor, Savonis, Strathcona, Meg, whatever, and just hold them for 5 years. You'll do good. They're going to consolidate down probably into a couple companies. And like I said, they don't have to invest any more money. The facility, all the risk is out of them because they just have to basically run what they got. And they have long life reserves, 50-year reserve life index. And you're just sitting there and you're going to probably beat the S&P if oil prices stay where they are, just on cash return to you as buybacks and dividends. And then if you do get a sustained oil price move, which I suspect is going to happen over the next 3 to 5 years, then you have optionality to the upside. The other group of, if you want to get aggressive and be more risky, I mean, just look at what's happened. If you look at the reporting over the last week or so of the senior gold producers, this is outrageous, the amount of cash. I mean, there's so much cash coming. It's like a South American drug lords. I mean, there's billions of dollars in cash flow coming in. And so what I like right now, I'll just go down the line here. In the past, these managements are no longer there, but in the past, the managements they would let this money burn a hole in their pockets. Stupid acquisitions, bringing on marginal projects, growth for the sake of growth. These mining executives that are there now are a different breed. They're more focused on returns to shareholders also. I do think, though, that you're going to see a mergers and acquisition wave because they haven't invested either. The big mining companies don't even have exploration, very small, if any, exploration going on. They rely on project developers or buying ounces on Wall Street or Bay Street. And so I think it's time to start looking down into the mid-tiers and into the junior producers that have projects that can be expanded or have upside. And I think there's going to be a wave of mergers and acquisitions there. Regardless, I think the gold price is going substantially higher. You're basically in a situation right now, which is the best of all worlds. You have the oil price relatively stable. And if it doesn't move higher, then diesel prices don't move higher. That's 35%, 25, 35% of your cost. And so all of this cash is just going to your bottom line. So I think looking at some of these stocks, they're still out of favor. If you look at the GDX, I think ETF, there's only been like 1 week where it hasn't, they haven't had to, there's a reduction in ETF shares. There's no interest in these stocks. And so I think that that's changing. You're seeing some of them break out. Kinross broke out the other day. Barrick just broke out. Everybody, Newmont, I mean, had to kind of kick the whole thing off. So I would be, if you want safety, you can buy these companies. I like Anglo Gold personally, but start looking down into the juniors and then look at the silver miners, because my view, and a lot of historically what has happened in the past, is that once the gold bull market gets going, eventually the silver will catch up. And there are, quite a few silver miners out there that are starting to get some traction. And, I'm talking about the possibility of some of these things, some 10, 20 baggers are out there if things play out like I think they will, which I think gold and silver prices are going substantial. All metal prices, precious metals are going higher. So in that context, I think there's opportunity there over the next 3 to 5 years. I think those are the two sectors I'm most bullish about stock-wise, and what I would tell the average person. You just have to do your homework, and you have to know what you're doing, and don't get caught up too much in the craze. Just buy good companies with managements that know what they're doing and have a real project. Don't go in for, well, they're going to be drilling here. There's no need to do that at this point. It's time just to because things are so mispriced right now relative to the cash flows, why not take advantage of that? And I think you will see consolidation over the next couple of years.
That's a great point. Okay, let's take a little bit conservative approach. Let's say the investor is looking for not for 5x or 10x. He's looking for 2x. But he's looking the sector that will bring him the fastest 2x to his portfolio. Which sector would that be in your opinion?
Oh, wow.
I know it's a hard question.
I don't know. I mean, that's difficult to say because you're starting getting more into some timing, what's going to happen. So I don't know. I don't want to say uranium because it's always out there. When's it going to take off? I don't know. It's just
Maybe silver.
silver. Yeah, I think so is possible. Yeah. I think just what I mentioned earlier, like gold and silver, mining stocks moving down into the smaller market caps, mid caps, and smaller caps, I think is where your best bet is right now.
Okay. Final question, John. What's the biggest mistake you see retail investors making in today's energy markets?
I think reliance on data from people like the IEA and EIA and these multinational entities that are kind of have ulterior motives, and so IEA, for example, has been negative on oil demand they've never been right on anything. So I think, it's a cyclical market, obviously, but I think that, until I see, for example, they were the ones, they and some other and people picked up on it in the media and a lot of the analysts, the EVs. EVs are going to displace. We're going to, the end of oil. I mean, when you start hearing things like this, you got to start looking at, I got to get on the other side of the canoe because everybody's on the other side. So I think that, the biggest mistake, you have to think for yourself and you have to go, to steal something that Rick Rule has said, I'll just use what he said. You have to be a contrarian in this business because if you're waiting to buy something when everybody else is there, the move has already happened. The problem with that is it's very difficult psychologically and emotionally to do that because you're sometimes standing there by yourself. When I was buying uranium stocks when uranium was $25 a pound, what was it, 5-6 years ago, myself and two other people on the internet were talking about it, and everybody said, "You guys are nuts. There's no way. Solar and wind are the future." Well, I was in that business. I knew that wasn't the future, so I had that leg up. So it's hard emotionally to sit there and do nothing happens for 2 or 3, 4 years. But this is what I tell people. Same thing that happened in platinum. Platinum was in deficit for a while already, and all of a sudden it just decides to go up. What's the catalyst? I don't know. It just money comes in and people rotate into it, and then it starts a flywheel. And so that's how it happens. And if you're not there to catch that, then you miss that move, and then you're always going to be chasing it. And I think that's the problem. A lot of problem with the retail investors is, you're either contrarian or a victim, as Rick Rule says, and they don't really understand how to be a real contrarian. And I think that's the big mistake.
That's probably the best Rick's quote I ever heard. Either you're a contrarian or you're a victim, and that is the truth. Everybody who is on the market, actually, I am on the market 20 years, and I learned that school 10 years ago, and that is the whole truth, definitely. John, thank you very much. How can people reach out to you?
I have the weekly videos on YouTube and on Substack, Actionable Intelligence Alert on Substack. That's where my free email that it goes out every week, and a paid service where we get into specifics of the things that we just talked about.
Excellent. John, thank you very much for this interview.
Thank you.